This is a tweet by Bernie Sanders, and wealth tax is at the heart of it. Even before the coronavirus, global inequality was rapidly increasing. But as we all know, following the coronavirus, billionaires made a bank and inequality is on the rise. And I am speaking about countries all across the globe, from United States to Australia to India. 20 million Americans lost their jobs, but US billionaires have added about 1.2 trillion to their wealth. Not million, not billion, but trillion with a T. More than 200 million Indians were pushed into poverty due to the coronavirus. But at the same time, the wealth of Indian billionaires increased by 35%. Russia is the most unequal country on this planet, followed by India. According to a research conducted in India, a 0.4% wealth tax on the top 10% families could pay the lowest 50% of the population for 3 months of their expenses. COVID-19 has caused many scholars, experts and politicians to debate the wealth tax. Therefore, in this video, we will understand the wealth tax, its complexities. What is the wealth tax? Wealth tax is based on the market value of assets owned by a taxpayer. In most countries around the globe, people pay taxes on their annual income, but their wealth is exempt from taxation. A wealth tax is imposed on everything, including stocks, real estate, car, jewelry and even paintings. So by now you must have understood that income is a part of wealth. And when it comes to income tax, two people with the same income but unequal wealth will be taxed the same. But one major difference between wealth tax and income tax is annual wealth tax rates are significantly lower than annual income tax. It's like in wealth tax you get 5% of a watermelon, but in income tax you get 20% of a grape. And according to Elizabeth Warren's proposed wealth tax, billionaires like Elon and Jeff will have to pay a wealth tax of $5 billion every year. Furthermore, under Elizabeth Warren's wealth tax plan, Americans with a net worth of more than 50 million will pay a 2% tax rate, raising to 3% for those with a net worth of more than $1 billion, billion with a B. And if this tax plan is implemented, it could generate more than $2.75 trillion over the next decade for the US economy. Bernie Sanders proposed his version of wealth tax with a 1% tax on wealth above 32 million and 8% on net worth over $10 billion. What are the pros of wealth tax? Wealth tax protects the democracy. Wealth concentration in hands of few will transport us to the time when kings ruled. The foundation fathers of United States hated it. They desired to establish an equitable economic structure. Concentration of wealth in few hands also conflicts with basic human rights such as justice and freedom of speech. Wealth tax are considered to be more equitable than income tax alone, especially in nations where the income gaps are large. This system produces government revenue from both taxpayers' income and net assets, which promotes fairness and equality by taking into considerations taxpayers' economic standing. The second pro is a wealth tax creates a more level playing field for everyone in politics and even in business. And according to a study by Brookings Institute, massive wealth is highly likely to influence the political process while lobbying and campaign financing. Massive amount of wealth may also have a negative impact over business competition, as wealthy individuals have more resources to block competition and create a monopoly. And we have seen this time and time again with a lot of companies. Another upside of wealth tax is middle class relief. After taxes and benefits, middle class income has grown half as quickly as that of wealthy over the last few decades. A wealth tax would not only raise taxes for the wealthy, but it would also lower the tax burden on middle class. Richard Reeves and Isabel Sohel who are senior fellows of economic studies at Brookings Institute, recommended that eliminating income tax for most middle classes by raising the standard of taxable income. Another upside of wealth tax is it increases the accuracy of taxing the wealthy. The ultra rich people do not rely on income. They do not receive a paycheck from someone else to make majority of their money. They make the majority of their money through investing and stocks. A lot of CEOs of S&P 500 companies do not even take salaries because they are the founders of those companies, so they have practically no income, no paycheck. But when you look at their wealth, they are billionaires. So wealth tax can provide a medium to accurately tax the rich people. What are the cons of wealth tax? There is a chance that wealthy individuals will relocate to another country to avoid paying taxes, as 42,000 millionaires did before France abolished its wealth tax in 2018. However, if billionaires and millionaires are trying to play games, the government also knows how to play games. The name of the game is exit tax. Both Warren and Bernie Sanders' wealth tax ideas handled this situation by imposing a 40% exit tax on anyone attempting to change their citizenship. Netherlands and Canada are the countries which have an exit tax. Another downside is wealth tax could harm the economy by killing business investment. Wealth tax reduces the interest of businessmen in terms of investing in an economy. Another major challenge for wealth tax is the administrative burden. Many types of wealth, such as privately held firms, personal and household goods, and some investments are difficult to value. The tax department need to have qualified antiques, jewelry and art experts to audit tax returns, and that could significantly put burden on tax authorities. Uncertainty about valuation will also motivate some wealthy people to engage in tax avoidance. But another major concern with wealth tax is illiquid assets, which means assets that cannot be easily sold in exchange of cash without a substantial loss in value. Owners of significant illiquid assets may lack ready cash to pay their wealth tax liability. This creates a problem for people who have lower income and low liquid savings but own a high level illiquid assets. For example, a farmer who earns little but owns a large amount of land with high value may have trouble coming up with money to pay wealth tax. But there is a solution to this problem as well, such as allowing tax payments to be spread over a period of few years. But this process is very complicated. Another big disadvantage is rich people across the globe have immense political power. Billionaires and millionaires are the ones who donate to political parties and their candidates. As a result, they may exert pressure on the government to avoid enacting the wealth tax. According to a study by Forbes, a wealth tax lowers the value of assets in an economy. The cons of wealth tax are very real, but income inequality is rising all across the globe. People are dying in third world countries due to shortage of oxygen. In first world countries, tuition fees are all-time high, and a wealth tax might be very useful resource.